Welcome to the News El Salvador SV podcast. This is a space for conversation and reflection where we explore current topics from El Salvador and the world together. Find US on your favorite platform. Look for us as News El Salvador SV. You can make contributions via PayPal link in the content description, and you can visit our online store where you'll find paid content that might be useful for you. Check the links you'll find in the content description. There you'll also find more ways to collaborate if you wish. And you'll also find exclusive episodes. Explore the links in the description. Remember to follow, share, and comment. Thank you so much. December 1, 2025. This date didn't just mark the start of a new financial quarter. It really feels like it initiated a period of intense global and regional volatility that demands, immediate professional analysis. So welcome to this deep dive. Our mission today is to take a focused, in-depth look at the events that really dominated this specific date, but also framed by the significant developments of the preceding weekend, November 29th and 30th. We're synthesizing information across three, highly interconnected areas. First, we have to dissect the financial shockwaves gripping the global cryptocurrency market, concentrating on that severe correction Bitcoin experienced. Second, we'll pivot to geopolitics, analyzing pivotal regional shifts. We're talking particularly about the consequences of the Honduran election and the escalating diplomatic pressure from Estados Unidos on Venezuela. And finally, we will bring the focus back home to El Salvador, assessing the latest socioeconomic indicators and security milestones that are defining its domestic situation right now.
It truly is a convergence of high-stakes situations. You're blending systemic financial instability with these dramatic political realignments right here in Central America. And we absolutely must begin with the market, because the severity and, frankly, the confusion surrounding the Bitcoin correction on December 1st were perhaps the single greatest shocks of the entire period.
Let's jump right in there. The start of December. It felt like a chilling reality check for the entire digital asset sector.
It was. Bitcoin, as the largest asset, is supposed to be the market's anchor, right? But instead, it suffered a brutal and dramatic market drop, and it instantly triggered this immense investor anxiety, not just regionally, but globally.
So on December 1st, what were the initial numbers telling us?
The data confirmed the asset was experiencing an intraday fall approaching 6%.
6% is already significant, but I get the sense the immediate data point suggested the market was reacting to much deeper, more systemic fears.
Exactly. The raw quotation data showed Bitcoin dropping sharply to $86,040.62 early that morning. That confirmed an immediate retreat from the high ground it had been holding.
And that retreat was fast.
Quick and painful. The price had already dipped to an overnight low of $85,626.75. Now, this is crucial because it confirms that the $86,000 level, which so many investors had been relying on as a major psychological support barrier, was definitively broken. It was under heavy, sustained pressure.
Right.
But here is where the story gets truly complicated for anyone trying to follow the market.
Yeah.
You had these conflicting data reports.
And conflicting information in a volatile market is profoundly destabilizing. It's like trying to navigate in a fog.
Precisely. So we have one set of highly reputable market data sources pegging the post-decline price at around $86,000, confirming the loss of that key support level we just mentioned.
Okay, so that's one clear, albeit negative, picture.
On the other hand, though, we had parallel reports, and these were equally distributed across certain data aggregators, stating that Bitcoin had plummeted below the $48,000 level.
$48,000, that's a completely different reality.
It's staggering. We are talking about a price point that hasn't been observed since the first quarter of 2025. It marks a drop that exceeded 30% from the previous month's highs.
So when you have the world's most watched digital asset being reported at both 86,000 and below 48,000 at the same time, what does that signal? How do we as analysts even begin to interpret this wide, almost an unbelievable discrepancy?
It signals a severe breakdown in market coherence, and you have to consider two primary theories here. First, there's what we could call the fragmentation theory.
Okay.
This suggests extreme differences in liquidity across global exchanges. For example, a sudden, massive institutional sell order might hit one smaller illiquid exchange, and that could drive the price down to 48,000 momentarily. It acts like a flash crash.
So it's a localized event, not the true market price.
Potentially. If the majority of trade volume is still holding the $86,000 level, then that lower figure represents a temporary dislocation, not a true valuation.
And the second theory?
The second and far more concerning theory is systemic panic. If that $48,000 price point was reported widely, regardless of how long it lasted, it indicates that a significant stop-loss cascade occurred across multiple trading platforms. It leads to this generalized fear that the recent bullish structure has been entirely invalidated. In either case, whether it's a temporary dislocation or generalized panic, the confusion itself creates an environment of profound uncertainty.
It causes investors to panic sell.
Exactly. They're fearing they are missing the exit before the true price drops to that lower reported level. This lack of a clear valuation, it just fundamentally erodes confidence across the board.
And that state of hypervolatility on December 1st, it wasn't an isolated incident, was it? It felt like the culmination of a month of clear fragility. You mentioned November closed on a weak note.
It was undeniably weak. November ended with Bitcoin retreating by 16.68%.
And for perspective,
that was the second worst monthly performance of the entire year. It was only surpassed by the 17.53% drop we observed way back in February.
So this reveals that the underlying health of the rally that pushed prices so high earlier in the fall was, well, it was already questionable.
It was. The market had stabilized, or at least it appeared to, above $90,000 in the weeks prior. The fact that the bottom fell out so dramatically suggests that underlying selling pressure was simply accumulating, just waiting for a trigger.
And the trigger came.
Absolutely correct. The pressure was mounting. We have to recall the historical context here. Bitcoin had hit its all-time high of $126,251 just a few weeks prior, on October 6, 2025.
Just a few weeks. It's incredible how fast things can change.
It is. So since that peak, the asset had accumulated a staggering drop of over 31% by December 1st. This dramatic retreat meant that any investment strategy that was predicated on a continuation of that bullish year-end rally was fundamentally altered. It forced many institutional and retail players to reassess their positions entirely.
Let's really delve into the specific causes, because it seems this decline was truly a multi-layered event. It was driven by systemic crypto failures, macro pressures, and these unprecedented supply shocks.
It was a perfect storm. It combined a technical trigger with forced market mechanics and a shifting macro backdrop.
Where do we start? What was the immediate technical trigger?
The immediate specific technical trigger that intensified the December 1st sell-off originated in the decentralized finance, or DeFi, ecosystem. Specifically, with an incident at Yearn Finance. This was a critical vulnerability.
What happened exactly?
An attacker managed to exploit a flaw, allowing them to mint, and by mint I mean is essentially create out of the thin air, an extremely large quantity of youth tokens.
Now, for listeners who may not be as deeply immersed in DeFi, can you quickly explain why minting fraudulent tokens like that is so damaging to the entire system?
Certainly. In DeFi, many assets are pooled together to provide liquidity for trading. The attacker's action was akin to counterfeiting a massive amount of cash and then dumping it into a shared bank vault.
Okay, I see.
This flooding of the pool with worthless, newly minted ETH instantly eroded the value of all the existing legitimate tokens and the underlying collateral in that system.
And that destroys trust.
It fundamentally destroys the core promise of DeFi, which is trustlessness. And because of the interconnectedness of the ecosystem, it immediately spills over, triggering risk aversion across the entire crypto market, and it drags Bitcoin down with it.
So that was the technical flaw, the spark. But a far more intractable problem seems to be this institutional and governmental selling pressure. That's something the market can't easily solve or absorb.
You're right, the governmental supply shock is unprecedented. We are observing continuous massive supply being introduced into the market that is completely divorced from typical investor sentiment or demand.
So which governments are we talking about?
Specifically, we have to highlight the progressive liquidations being conducted by authorities in the German state of Saxony. They are selling off significant amounts of seized Bitcoin.
And this is being aggravated by others?
Yes. It's further aggravated by similar coordinated movements originating from the government of Estados Unidos concerning large volumes of their own seized funds.
So why is government-first liquidation different from, say, a hedge fund selling off its assets? It's all just selling pressure, isn't it?
It's different because it creates a non-stop forced supply. When a fund sells, it might signal poor confidence, but it's still reacting to market conditions. They might stop if the price gets too low.
But a government won't.
Exactly. When a sovereign government sells seized assets, it's purely an operational action. They have the Bitcoin, they need to convert to fiat currency, and they must sell it regardless of price or market appetite. This persistent, inelastic selling pressure acts as a massive cap on any price recovery.
And it signals a negative fundamental factor that would scare institutional buyers away.
It's a huge red flag. It's often cited as a reason to stay away, and it transforms the market dynamics entirely.
And all of this is occurring within this challenging global economic climate, driven largely by the macro decisions coming out of Estados Unidos.
Exactly. The macroeconomic headwinds are just unavoidable. Recent economic data from Estados Unidos has been stronger than many predicted, which has reinforced expectations for prolonged high interest rates globally.
Making risky assets less attractive.
Inherently less attractive. In this environment, speculative risk-on assets like Bitcoin just can't compete with the higher returns available from fixed income assets or the relative safety of a strengthening US dollar. The opportunity cost of holding volatile assets increases dramatically.
So this confluence of factors directly impacted investor behavior.
It resulted in a dramatic chain reaction. First, we saw significant profit-taking among earlier investors who had pushed Bitcoin above $125,000. That compounded the negative sentiment.
But then came the critical blow.
The devastating blow was the technical loss of the $60,000 psychological support level.
Explain for our listener what happens when a key level like 60,000 is lost and what leveraged positions means in this context.
Of course. Think of leveraged positions as investments made with borrowed money. If you are leveraged, a small drop in price can wipe out your entire capital and trigger a mandatory sale, which we call a liquidation.
And 60,000 was a key trigger point.
It was a major point where many traders had set their automated stop-loss triggers. These are instructions to sell immediately if the price falls below that point to prevent larger losses.
So when 60,000 failed,
it triggered an immediate automated wave of selling from these leveraged positions. We're talking estimates in the billions of dollars in the preceding 24 hours alone, according to specific market data. This forced selling created a panic-driven, self-fulfilling prophecy of rapid decline, which just exacerbated the technical failure from year-end finance.
And institutionally, did we see a flight to safety confirmed by outflows from the regulated investment vehicles?
We did. The data on institutional capital flight is unambiguous. We observed significant net outflows from the regulated financial products, specifically the Bitcoin Exchange-Traded Funds, or ETFs, in Estados Unidos.
And those are the main gateway for big money.
They're the primary mechanism major institutional players use to gain exposure. So when you see net outflows, it signifies that institutions are not just pausing new investments, they are actively withdrawing their capital. They're removing a massive pillar of support that had fueled the market earlier in 2025.
As Bitcoin stumbled, what was the immediate effect on the wider digital asset landscape, the altcoins?
The altcoin market tends to suffer disproportionately in these scenarios. It reflects a generalized flight from speculative risk toward liquidity, toward cash.
What did the numbers look like?
Ethereum, the second largest cryptocurrency, dropped notably, suffering losses between 5.7% and 6%. XRP fell sharply, with a range from 7.3% to almost 8%. And Solana also registered steep declines, dropping somewhere between 7.5% and 8.53%.
So it was a market-wide bleed.
It was. These figures clearly illustrate the generalization of panic and the widespread reduction of speculative holdings across the entire board.
So looking ahead from that moment, analysts seemed sharply divided on the market's trajectory. It was either a sustained downturn or just a necessary correction.
Precisely. There was a clear divergence in perspective. The first, more bearish view was the crypto winter scenario.
What's the argument for that?
Proponents argue that the continuous fundamental factors, those persistent governmental sales and the confirmed institutional exits, are simply too much for the market to bear. They predicted a prolonged, painful correction.
And were they targeting specific price levels?
Yes, potentially testing much deeper support levels, possibly in the $42,000 to $45,000 range. This drew credence from those initial lower $48,000 reports, or, at the very least, they anticipated a struggle to hold the next major psychological support around $80,000.
So what gives weight to the counter-argument, the healthy correction scenario?
This more optimistic view maintains that the market was currently undergoing a necessary cleansing. It argues that the decline was effectively purging the excessive leverage built up during that rapid run-up above $125,000.
So get rid of the froth to build a stronger foundation.
Exactly. Under this theory, once the forced selling pressure, particularly those large government liquidations, is finally absorbed and exhausted, the market will locate a stable, fundamental floor. At that lower, more attractive level, long-term, value-oriented investors who were previously sidelined by high prices will step back in, providing a robust base for future growth, albeit slower growth.
And as we touched on, the irony is that while crypto was collapsing under these unique pressures, the macro signals from the Federal Reserve and Estados Unidos were actually becoming marginally more accommodating.
That is the essential context that keeps the door open for that healthy correction narrative. Despite the short-term macro pressures, the latest signals regarding Federal Reserve policy were leaning dovish.
What were the odds of a rate cut?
Expectations had strengthened significantly. At that point, standing at an 87% probability of a 25 basis point rate cut scheduled for December 9th or 10th. This was being driven by indicators suggesting inflation was moderating and growth in Estados Unidos might be weakening slightly.
And there was a political element to this as well.
Furthermore, yes, the political noise from Donald Trump regarding his upcoming nomination for the next Federal Reserve chairman had intensified speculation. Many interpreted his comments as signaling a potential inclination toward looser, more expansionary monetary policy. So while this doesn't stop the immediate government liquidations, a shift toward lower rates in the medium term typically favors speculative risk-on assets. It's that constant tension between the immediate supply shock and the potential for future monetary policy relief that kept the market so uncertain.
A truly volatile and complex financial picture, defining the start of December. Let's now shift our attention to the dramatic geopolitical events happening simultaneously, which also deeply involve the policies of Estados Unidos. The final weekend of November and the first day of December were marked by significant political transitions in Central America. And I think most notably, we have to look at the outcome of the Honduran elections, which carry immense geopolitical weight.
The regional implications of this election really cannot be overstated, particularly when you think about the ideological alignment of Central American nations.
Based on the reports covering the counts following the November 30th election, the key result indicates that the right-wing candidate, Asfura, is reported to lead with a slight advantage.
And how slight was that advantage?
One source detailed his lead at 40.61% of the votes over the main opposition contender, Salvadoran Nasrallah. And this outcome is being widely construed as a decisive defeat for the political left in Honduras.
The political narrative that's emerging from this result it's both explicit and deeply critical of the previous administration, isn't it?
It is. The prevailing editorial interpretation views this outcome as a resounding rejection by the Honduran electorate of what is described as the shameless nepotism of the Zelaya Castro family. But more broadly, the vote is being framed as a repudiation of their perceived alignment with the socialism of the 21st century dictatorships that have defined certain political landscapes across Latin America. So this effectively shifts the electoral result from merely a domestic change of power to a statement about regional ideology and alliances. And this brings us directly to the geopolitical angle. Asfura is not just a right-wing candidate. He is explicitly presented in the sources as the Trump candidate. What does that label signify in the current context of Central American power dynamics?
Well, that label fundamentally links the outcome of the Honduran election to the strategic foreign policy of Estados Unidos. It suggests that this election was viewed not just as a choice for Honduras, but as a critical strategic point in Central America for the conservative political movement.
So it's part of a larger strategy.
It serves as part of a broader effort to consolidate ideological alignment in the region, which partially explains the clear expressed interest and involvement of Donald Trump in the electoral process, and of course, the subsequent immediate recognition of the results. But looking ahead, the new government, despite this geopolitical backing and this ideological shift, it faces a daunting economic reality.
It does. It will inherit a mixed situation. Modest, moderate growth, but simultaneously burdened by high levels of national debt and persistently high poverty rates that require immediate attention. So the political victory provides that regional alignment, but the economic challenges are structural and they're not going away. Now, shifting our focus southward, the period leading into December 1st also saw an alarming escalation of diplomatic tension between Estados Unidos and Venezuela, centering on direct and unambiguous actions by Donald Trump.
The level of diplomatic pressure being exerted on Nicolás Maduro has moved far beyond traditional sanctions. It really reached an inflection point characterized by a direct ultimatum.
The pressure began with what was reported as a direct, non-negotiable threat delivered during a phone conversation between Donald Trump and Nicolás Maduro.
And what was that threat?
The threat was explicit and time-sensitive. Maduro and his inner circle were given only a few days, a remarkably short window to voluntarily abandon Caracas. The warning stated unequivocally that should they fail to comply, the government of Estados Unidos would utilize military action.
That kind of rhetoric is extremely rare. It signifies a drastic change in foreign policy approach, moving toward immediate physical isolation and intervention capability.
And this verbal ultimatum was immediately formalized by a definitive public declaration from Trump. He announced that the airspace over and around Venezuela must be closed in its entirety. He specifically targeted all airlines, pilots, drug traffickers, and human traffickers, clearly signaling an intent to impose a total enforced isolation strategy. It was designed to cripple the regime's ability to move personnel, goods, or any illicit activities.
And the global community immediately focused on the implications of this isolation. You had figures like Senator Mullen, for example, suggesting that if the pressure became unbearable, Maduro might be compelled to seek asylum or refuge in a country like Russia or another known supportive nation.
So it highlights the immediate global ripple effect. Estados Unidos was attempting to force a swift, definitive conclusion to the political deadlock in Venezuela. Now, we must connect these high-stakes geopolitical maneuvers back to domestic policy in Estados Unidos, specifically the stringent and often controversial immigration decisions being implemented at the same time.
The hardline stance on foreign policy and regional control seems to perfectly mirror the hardline stance on migration control at home.
Absolutely. The president issued a firm warning regarding the suspension of asylum decisions, clarifying that this suspension will last for a long time. This indicates a permanent shift in immigration posture designed to halt the flow of people seeking refuge, and it aligns directly with his previous stated promise to permanently pause migration from what he terms third world countries. Furthermore, the enforcement arm of this policy was actively deploying on the ground. Reports indicated that immigrants in cities like New Orleans were preparing for the commencement of large-scale migratory raids, or redadas, which were scheduled to begin precisely on December 1st. This marks the transition from policy declaration to active enforcement.
And critically, we see a judicial movement that links this stringent immigration enforcement directly to the Central American security environment, and specifically to El Salvador.
Yes, on November 29th, Judge Boasberg issued a significant court order. This order explicitly instructed the government of Estados Unidos to deliver the declarations of those involved in authorizing deportation flights destined for El Salvador's controversial security center.
The Center for Confinement of Terrorism, or CCOT.
Exactly, CCOT.
For our listeners, CCOT is that massive high-security prison complex that has become the centerpiece of El Salvador's stringent security policy. The significance of this U.S. court order is that it implies international judicial scrutiny is now being placed not just on U.S. deportation policy,
but on the destination itself.
Exactly. It's on the conditions, the logistics, and the procedures surrounding the use of El Salvador's specific security infrastructure for processing deported migrants. It puts El Salvador's security system under the legal microscope of Estados Unidos.
These intertwined threads, the global financial collapse of Bitcoin, the shift in Central American political ideology via the Honduran election, and the high-pressure foreign policy against Venezuela, they all exert this tremendous interconnected external force on El Salvador, which brings us to our final analytical section.
El Salvador's economic situation, as December 2025 commenced, it presents this pronounced internal stability and fiscal strength. Yet it rests precariously upon a foundational structural dependency on external factors.
The reliance on remittances sent home by Salvadorans living abroad is the overwhelming data point that defines this financial situation, isn't it? It showcases the nation's profound linkage to the U.S. economy.
The numbers are unambiguous. Family remittances reached their highest recorded share of GDP in the second quarter of 2025, constituting a massive 27.67%.
27.67%.
It is. And to provide necessary context, this reliance solidifies El Salvador's position as the third economy in all of Latin America most dependent on family remittances. This is not a secondary economic factor, it is the primary financial lifeline.
And the volume has been increasing
Steadily. Remittances grew by 18.2% through October 2025, and that followed an 18.5% growth rate up to September 2025. This consistent, massive influx provides the essential liquidity and consumption power that underpins the nation's current perceived economic stability.
However, the dependence is only half the story. The analysis of how these funds are used domestically reveals the fundamental structural vulnerability you mentioned.
That vulnerability is the critical investment gap. Analysis reveals that only a minimal fraction, a mere 1% of these substantial remittances are directed toward productive investment within the country.
Only 1%? That's shocking.
It is. The overwhelming majority, therefore, fuels consumption. It's paying for daily necessities, servicing debt. And while consumption provides immediate relief and prevents poverty from worsening, it fails to build long-term, self-sustaining economic infrastructure.
Meaning the country remains locked in this dependency cycle.
Precisely. If the U.S. economy were to slow down significantly, or if immigration policy were to drastically restrict job opportunities for the diaspora, El Salvador's economy would immediately face catastrophic headwinds because there is no robust domestic investment engine to compensate for that loss.
But on the fiscal performance front, the government has shown positive results.
They have. Latest metrics confirm that fiscal revenue grew significantly, increasing by $585.7 million through October 2025. This indicates strong governmental capacity in tax collection and administration, or perhaps robust underlying economic activity. It provides a positive counterpoint to the structural dependency on external money transfers.
Turning to security and legal updates, November 2025 was a benchmark month for the country's core security policy, which remains a central pillar of the current administration's success.
The consistent delivery on security metrics is crucial for internal confidence and for external perception.
Absolutely. El Salvador closed November 2025, having registered 0 homicides on 26 separate days throughout the month. This achievement underscores the pervasive impact and effectiveness of the existing security strategy and the government's ability to control gang violence. And this operational success is constantly reinforced by specific enforcement actions. We saw the confirmed capture of an alleged gang member with a history of extortion, Vanessa Marjorie Crespin Medrano, who was arrested in Santa Ana. But to understand the intensity of this security drive, we have to step back and provide some historical context regarding the material investment that paved the way for these successes. Analysis of armament imports reveals a complex detail. In 2022, the same year the state of exception began, El Salvador imported a record quantity of armament. And this single-year import represented a massive 10% of the total amount imported over the preceding 30 years.
10% of 30 years worth of imports in a single year? That figure is astonishing. It means the security apparatus underwent a complete, rapid militarization over the past few years.
And it provides the context.
It does. This massive front-loaded investment in military and policing infrastructure provides the necessary context for the rapid and profound operational successes, like the 0 homicide days that are now being recorded.
Yeah.
It required that material force, coupled with the legal framework of the state of exception, to create the conditions for the current security environment.
And this rapid material and operational change, it contrasts quite sharply with the speed and progress of certain legislative and judicial reforms.
That disparity in pace is noticeable.
Regarding governmental and legal procedural changes, we can note a positive modernization step. The court implemented a new digital protocol system, which was slated to begin operating precisely on December 1st. This marks a clear move toward modernizing and streamlining court proceedings. Nevertheless, we must also note the significant political gridlock impacting highly sensitive legislation. The project for the transitory justice law has been stalled for a full year in the Legislative Assembly.
A full year?
Yes. The inability to move this complex, high-stakes political legislation forward indicates ongoing difficulty in achieving consensus on sensitive historical and legal issues.
There's it.
And finally, we should briefly acknowledge the cultural and civic life developments from the preceding days, showcasing the nation's ability to function and celebrate amid these high-level political and financial events. The weekend of November 29th and 30th saw the spectacular lighting of the 50-meter Christmas tree in Plaza Salvador del Mundo. Furthermore, the 66th Carnaval de San Miguel was successfully hosted, featuring globally recognized acts like Juan Luis Guerra, alongside prominent local artists such as Nori Flores.
And to tie back to that persistent structural issue, the Migration Directorate reported specific figures that underscore the continuous cycle of migration and return. 9,431 Salvadorans were returned from Estados Unidos between January and September 2025.
And that steady flow of returns reinforces the continuous nature of the migration cycle,
Which, as we noted, is fundamentally linked to the nation's entire economic structure.
When we pull together all the diverse threads we've analyzed in this deep dive, the financial volatility, the geopolitical maneuvering, and El Salvador's domestic situation, the pervasive influence of Estados Unidos emerges as the single most critical, overarching narrative.
It does. The global superpower's economic and political gravity simultaneously shapes the conditions in the crypto markets of Asia and the electoral outcomes in Central America. There's an undeniable nexus of cause and effect. Financially, the impact is structural. Expectations regarding interest rates in Estados Unidos, even with a more favorable probability of a Federal Reserve rate cut, inevitably drive the dollar's strength and dampen enthusiasm for high-risk speculative assets like Bitcoin. This directly affects the value of El Salvador's key financial asset holdings and influences global capital flows.
And at the same time, the political and migratory actions of Estados Unidos directly dictate regional stability and migration flows.
Absolutely. Trump's hardline immigration stance, the suspension of asylum and the announced remittances, directly influences the flow of people, and consequently, the volume of those essential remittances. Geopolitically, the pressure on Venezuela and the open support for the Trump candidate in the Honduran election demonstrate these regional policy maneuvers that affect every country in the hemisphere, forcing decisions about alliances and ideological alignment.
And crucially for El Salvador, this external influence translates into immediate, tangible economic vulnerability.
It creates a direct dependency pathway. We highlighted El Salvador's massive reliance on remittances, which constituted 27.67% of its GDP.
A huge number.
And since these funds originate overwhelmingly from the diaspora in Estados Unidos, the political or economic stability in Estados Unidos directly and immediately determines El Salvador's fundamental economic health. That Judge Boasberg court order regarding CECOT deportations is a perfect, tangible example of this linkage, where the judicial system of Estados Unidos directly intersects with El Salvador's most controversial security policy.
As we conclude this complex analysis of the current moment, it is, I think, necessary to place these sudden events in a broader historical context, reflecting on a significant anniversary that fell precisely on this date.
A moment of profound global reflection is certainly warranted. It's a reminder of the potential for sudden systemic shocks.
December 1st, 2025 marks 6 years since a pivotal global event began, the initiation of the COVID-19 pandemic. On December 1st, 2019, in Wuhan, China, a man began manifesting symptoms that were later confirmed as the first documented case of COVID-19. That singular event initiated a cascade that entirely reshaped global finance, politics, supply chains, and social interaction for years to come.
Recognizing this 6-year anniversary underscores a critical lesson for our deep dive today. How quickly global stability can be overturned by a single systemic event, be it a virus or a technical failure like the one at Urine Finance. The world remains incredibly interconnected and susceptible to sudden, deep instability. And that historical reflection leads us to our final provocative thought for you, the listener, to consider. We've witnessed the cryptocurrency market descend into extreme volatility, with those disturbing conflicting price reports of $86,000 versus $48,000. It was triggered by technical failures, but fundamentally aggravated by state-level asset liquidations. Specifically, the continuous forced selling by the German state of Saxony authorities and the government of Estados Unidos. So given that sovereign governments have now become dominant, destabilizing supply factors in a major global asset class, should global financial regulators and institutional investors redefine the very concept of a risk asset, when the largest source of market pressure comes not from individual panic, but from sovereign operational action?
We have certainly covered extensive ground in this analysis. To conclude, we will summarize the 3 most important conclusions drawn from this deep dive into the events surrounding December 1st, 2025.
Conclusion 1. Extreme cryptocurrency instability. The Bitcoin market faced a severe, complex double shock on December 1st, 2025. This instability was fueled first by a critical DeFi technical failure, the Urine Finance incident, which triggered systemic fear, and fundamentally amplified by the unprecedented scale of ongoing governmental liquidations from entities like German authorities and the government of Estados Unidos. These structural supply shocks completely overshadowed any expectations of favorable monetary policy shifts from the Federal Reserve, driving Bitcoin into a territory defined by profound uncertainty and conflicting valuation data.
Conclusion 2. Geopolitical decisiveness in Central America. The Honduran election results, which confirmed Asfura's lead, solidified a regional ideological shift toward the right. This occurred in the context of explicit, high-stakes geopolitical involvement from the government of Estados Unidos, evidenced by Donald Trump's severe military-backed ultimatum issued to Nicolás Maduro and the focus on regional security strategies that directly link Central American nations to the security agenda of Estados Unidos.
Conclusion 3. El Salvador's contradictory stability. El Salvador continues to demonstrate significant security gains, highlighted by closing November with 26 days of zero homicides, backed by historic armament imports, which defined the previous year. However, its underlying economic structure remains heavily exposed to external factors, confirmed by the highest reliance on remittances in recent history, accounts for 27.67% of its GDP in Q2 2025, confirming the country's delicate reliance on the economic health and policy decisions originating in Estados Unidos.
Thank you for joining us for this in-depth exploration of the sources. We encourage you to continue your learning and reflection on the interconnectedness